The government has issued a severe directive, warning citizens to prepare for economic sacrifices matching the intensity of the COVID-19 pandemic. Prime Minister Narendra Modi publicly appealed for a 7-point nationwide commitment: halt gold purchases, delay foreign travel, implement work from home, cut fuel consumption, use public transport, reduce cooking oil, and switch to natural farming. Now, this presents a striking analytical paradox. The leader of a massive emerging economy is asking citizens to stop engaging in normal consumer behavior during a time of relative domestic peace. May's 7 appeals act as macroeconomic emergency brakes, deployed specifically to halt the rapid depletion of the nation's US dollar reserves. This sudden currency drain stems from a catastrophic supply chain blockade thousands of miles away. Individual consumption now directly impacts national security. The logic behind these 7 rules reveals the precise mechanics by which global maritime choke points dictate local retail prices. The global supply chain relies on a few critical vulnerabilities, primarily the Strait of Hormuz, the primary artery for global energy and logistics. The ongoing geopolitical conflict involving the US, Israel, and Iran has resulted in Iranian forces effectively blockading this specific passage. This shipping corridor is currently experiencing a total systemic failure. Right now, over 1,700 cargo ships are trapped or heavily delayed in the Persian Gulf. Iran is enforcing a permission-based routing system. It operates as a hostile toll booth, halting the free flow of global trade until specific geopolitical demands are met. Most countries maintain a 70-day strategic oil reserve to absorb temporary supply shocks, but with this blockade extending past 2.5 months, that safety net is exhausted. Because the strategic buffers have failed, the economic shockwave of this single maritime choke point is now cascading directly onto the balance sheets of import-dependent nations. Navigating this crisis requires foreign exchange, or forex, reserves. International trade, particularly in energy, is conducted almost exclusively in US dollars. This model visualizes a nation's forex reserves as a reservoir. Under normal conditions, export inflows must balance import outflows to maintain a stable level. As the Hormuz blockade spikes global energy prices, the nation's 10 lakh crore oil import bill accelerates, causing a massive and immediate outflow of US dollars. Concurrently, India imports 26% of the world's gold, which drains an additional 6 lakh crore annually from the reservoir. The Gulf blockade also disrupts agricultural supplies, risking another 1.5 lakh crore outflow to secure essential fertilizer imports. When external supply is constrained but domestic demand remains constant, the nation bleeds forex at an unsustainable rate. If a state cannot secure its external supply chains through diplomacy, its remaining mathematical option is to crush internal demand to stop the bleeding of dollars. This brings us back to the Prime Minister's 7 appeals. They function as specific macroeconomic toggle switches designed to plug these specific leaks. The mandates targeting gold and foreign travel directly shut off the outflow of US dollars for non-essential luxury assets. The instructions to work from home and use public transport are direct interventions to mitigate the 10 lakh crore oil deficit. Pushing natural organic farming is an attempt to bypass the disrupted 1.5 lakh crore Gulf fertilizer import pipeline, and the directive to reduce cooking oil consumption aims to lower immediate dependencies on imported agricultural commodities. This policy represents a direct transfer of liability. The financial burden of a geopolitical crisis is shifted from the state's strategic reserves directly onto the individual citizen. This dynamic inevitably draws public critique, as citizens are asked to carpool and restrict travel, while state officials continue to operate fuel-heavy political convoys. Regardless of the optics, these mandates are a response to a strict mathematical reality. If consumption does not drop voluntarily, the country risks defaulting on its essential imports. The microeconomic consequence arrives quickly. Blocked ships and inflated oil costs immediately spike global freight rates. High freight costs create a causal loop of inflation, raising the retail price of everyday goods, from soap to basic food items. Relying on citizen austerity during a severe supply chain collapse has long been a recurring historical defense mechanism. Prime Minister Jawaharlal Nehru previously warned citizens about the domestic inflation caused directly by international wartime supply shocks. In 1965, Lal Bahadur Shastri asked citizens to voluntarily fast to offset severe agricultural deficits. And during the 2013 balance of payments crisis, P. Chidambaram explicitly requested that the public stop buying gold to protect the rupee. Across different decades and political parties, public austerity remains the default state response to forex vulnerability. It illustrates the ongoing challenge of achieving true strategic autonomy. As the state implements austerity to defend the national balance sheet, individuals must decide how to defend their personal wealth. As the nation bleeds forex, the domestic currency weakens against the dollar. This directly imports inflation and erodes local purchasing power. This chart illustrates a structural hedge. It tracks the mathematical advantage of holding assets denominated in a stronger foreign currency to offset domestic depreciation. Platforms like iEndMoney facilitate this structural hedge by allowing investors to directly acquire high-performing U.S. tech stocks. This strategy allows an investor to capture both the market growth of the asset and the premium gained when converting U.S. dollars back into a weaker domestic currency. In an era of unpredictable geopolitical conflict and sudden maritime blockades, relying solely on domestic markets leaves individuals exposed to systemic inflation. The current crisis demonstrates that domestic economies remain subordinate to distant, fragile maritime choke points. Strategic supply chain autonomy remains the long-term goal. Until then, state-mandated austerity and individual currency hedging represent the current frontline response to global